if the U.S. military, just suddenly lost access to a single, pretty unassuming 90,000 square foot warehouse in upstate New York tomorrow.
Oh, it would be a disaster.
Right. Their transition to next generation night vision, secure space communications, all that autonomous targeting stuff, it would just hit a massive, immediate bottleneck.
Total standstill, yeah.
So welcome to the deep dive. Today, we are going to decode how a small, basically under-the-radar U.S. manufacturing company serves as a perfect bellwether for these massive global shifts we're seeing in AI, space, and defense supply chains.
Yeah, and it really is a phenomenal case study. I mean, it shows the messy, high-stakes reality of actually bringing advanced manufacturing back to the United States.
Oh.
We spend so much time analyzing software, right, or silicon.
Yeah, always the chips.
Exactly.
Yeah.
But we often ignore the physical components, the hardware, that allows those systems to actually interact with the real world.
Which is exactly what we're looking at today. So for you listening, to map this out, we are looking at a stack of incredibly detailed sources on a company called Syntec Optics. Their ticker is OPTX.
Yep.
We've got their market beat financial summary, their Q4 2025 earnings call transcript, which is dated March 31st, 2026, and their deeply complex Form 10-K annual report for the fiscal year ending December 31st, 2025.
The 10K is where the real story is, honestly.
Oh, absolutely. And just to establish the stakes here for everyone, this is a stock trading under $10. I think it closed recently at $8.59.
Which is tiny.
Right. Yet it sits squarely at the intersection of some of the most critical technologies of our time.
Yeah, which really forces you to ask a fundamental question, right? How does a microcap company end up positioned at the very center of global technological infrastructure?
Right. How does that happen?
Well, you can't really understand their current financial turnaround without first understanding the actual manufacturing mechanism behind what they make.
Okay, let's unpack this. Syntec's core advantage is pioneering polymer-based optics. But we need to look at why that matters from an industrial scaling perspective.
Yeah, it's a huge shift.
Right, so think of this like the transition from heavy, fragile CRT tube televisions to lightweight flat screens, but applied to military night vision goggles and satellite sensors.
That's a great analogy, actually, because when you manufacture traditional glass optics, you are literally grinding and polishing individual glass blanks.
Handcrafting them, basically.
Exactly. It's a time-intensive, labor-heavy process of subtraction. But Syntec shifted that whole paradigm to polymers. What's fascinating here is how the mechanism works. With polymer optics, you front-load all the complexity.
Meaning you do the hard part first.
Right. You spend an enormous amount of engineering capital creating a master mold with submicron precision. But once that mold is perfected,
and you just stamp them out.
You can inject optical-grade polymers and produce thousands of identical perfect lenses in the time it would take to polish just a single glass counterpart. Yeah, and the 10K details that this specific shift yields cost savings of, like, 50 to 150 times over traditional glass.
50 to 150 times. That's insane. That structural cost advantage alone is massive. But, the sources make it clear that it goes far beyond just unit economics. The physical properties of the polymer itself dictate the end-use applications.
Yeah, it changes what you can actually build.
Right, because polymers are drastically lighter than glass. So if you consider a modern soldier whose helmet is already loaded with encrypted communication gear, ballistic armor, heavy battery packs...
All that weight adds up fast.
Exactly. Adding heavy glass night vision goggles directly contributes to neck trauma and fatigue. Yeah. Swapping glass for polymer fundamentally changes the ergonomic reality for the soldier.
And it changes the aerospace reality, too. I mean, in orbital mechanics, mass is quite literally money.
Right, because of rocket fuel.
Exactly. Every additional ounce on a satellite payload requires more fuel to achieve orbit. So lighter polymer lenses directly translate to much cheaper deployment for low Earth orbit satellite arrays.
Makes total sense.
And furthermore, these polymers are biocompatible and really highly impact resistant. So in a medical context, like a surgical instrument or a blood analyzer, a shattered glass lens is a catastrophic failure.
Oh, yeah, you don't want glass breaking in a surgical tool.
No, absolutely not. A polymer lens eliminates that specific vector of mechanical risk.
But, the technology alone doesn't entirely explain their position. I mean, plenty of manufacturers can injection mold plastics.
Right.
The sources point to their physical infrastructure as the actual moat. Syntec also does glass and metal optics, but their real secret sauce is that 90,000 square foot facility in Rochester, New York. They do everything internally.
Everything under one roof.
Yeah, they make their own mold tools, they apply their own thin film coatings, they do the nanomachining with sub-micron tolerances.
And we really should contextualize what that consolidation means for an advanced supply chain. When a defense contractor sources an optical assembly traditionally, the glass might be ground in one facility, shipped across the country, to be coated by a second vendor.
Sounds like a logistical nightmare.
It is. And then it's shipped overseas to be mounted into a housing by a third vendor. Every time that component changes hands, you introduce transaction costs, shipping delays, and most importantly, yield loss.
Right, because things get broken or made wrong.
Exactly. And if the final assembly fails quality control, the three vendors just blame each other. But by keeping the design, molding, coating, and testing all internal, Syntec collapses that entire logistical vulnerability.
Which is a massive strategic advantage. But here's where the narrative hits a wall for me.
Yep.
Syntec has been around for decades. They combined three 1980s companies back in 2000. Wait, if they've had this amazing polymer tech for 20 years, why are we seeing a sudden influx of interest right now?
That's the million-dollar question. And the answer is that macro geopolitical shifts finally caught up with their business model. CEO Al Kapoor actually pointed directly to this structural tailwind in the Q4 2025 earnings call.
The NDAA.
Yes. The catalyst is the 2026 Defense Authorization Act. This legislation has fundamentally altered the procurement landscape. It basically forces defense contractors to comprehensively map their supply chains and eliminate any reliance on adversary nations.
And they have a deadline for that, don't they?
Yeah, they have to fully transition to U.S.-based suppliers by 2030.
Wow. So the government is essentially mandating a forced reshoring of advanced manufacturing. Defense giants can't just optimize for the lowest cost by sourcing overseas anymore.
Exactly. They have a strict 4-year regulatory window to migrate everything to domestic soil. And that completely rewrites the demand profile for a company like Syntec.
Right, because they're already here.
They aren't just pitching a cheaper lens anymore. They are offering a turnkey, domestically secure compliance solution for these defense primes who are scrambling to meet the NDAA mandates.
It turns that facility in Rochester from a simple factory into a literal geopolitical asset.
Absolutely.
But here's where it gets really interesting. Syntec isn't just in defense. The sources reveal a highly aggressive expansion into new end markets. They added the communications sector back in 2023.
Yep.
And 2026 started with record-level space optics, production-like transmitters for those LEO satellites we talked about. Plus, they initiated production for an AI data center optics line, and they got a grant from NIST for advanced sensing projects.
The AI data center integration is particularly telling, I think. As data centers scale up to handle the massive compute loads required by AI, copper wiring simply cannot move data fast enough without generating just prohibitive amounts of heat.
They melt, basically.
Yeah. So the industry is shifting to optical interconnects, using light to transmit data between server racks. Syntec is positioning itself to supply the physical lenses required to couple those fiber optic cables to the silicon.
Which connects to a much broader industrial theme for you listening. Think about Industry 4.0, this marriage of physical production with AI and big data. We obsess over the software, the algorithms, the robotics.
Right.
But software is totally blind. An autonomous vehicle algorithm can't function without LiDAR and optical scanners feeding it data. A smart factory floor needs machine vision to detect defects. All these software evolutions are entirely reliant on their ability to perceive the physical world.
And Syntec makes the literal lenses for those eyes. It is the hardware foundation of the software revolution.
Exactly. But if the tech is so revolutionary and the tailwinds are this strong, why is this stock trading where it is, and why is management calling Q4 2025 a turning point? We need to shift from the shiny technology to the gritty financial reality.
Yeah, the numbers tell a very different story.
They really do. Let's break down this paradox in the Q4 and full year 2025 numbers. Full year net sales actually dropped slightly to $28.1 million. That's down $0.4 million from 2024. But yet, profitability skyrocketed. Q4 gross margin doubled quarter over quarter to $1.8 million, and full-year adjusted EBITDA rose 37% to $3.0 million. How are they making so much more profit on less revenue?
If we connect this to the bigger picture, it's because Syntec is finally aligning its cost structure. It's the classic friction point between brilliant engineering and scalable corporate finance. Right?
Yeah.
The key metric from the earnings call is their SG&A selling, general, and administrative expenses. In Q4, their SG&A fell by a massive 40% year over year.
40%. You don't just accidentally shave 40% off your operating expenses.
No, absolutely not. That requires surgical changes to how the factory floor operates every single day.
And the CEO, Al Kapoor, outlined specific management frameworks for this, didn't he?
Yes.
He calls them WCFE, which is Work Center Focused Effort, and MSV, Macro Societal View, which, sounds like corporate jargon.
Very much so.
But when you strip away the acronyms, it's basically a rigorous application of lean manufacturing. The transcript mentions them using Gemba walks, looking at daily batch sizes, and measuring the daily cost of poor quality.
And that focus on the daily cadence is the crucial mechanism. In a traditional, poorly optimized factory, you might run a batch of 10,000 lenses over a week, only to discover in final testing that a slight calibration error ruined the entire batch.
Which means you lose all those materials and a week of specialized labor.
Exactly. But by tracking the cost of poor quality daily or even hourly during a Gemba walk, they catch that calibration error on the 10th lens instead of the 10,000th.
It sounds to me like they finally stopped just behaving like a lab, inventing cool things, and started actually managing the factory floor to make money.
Exactly. And that is exactly what improved production yields means in the earnings report. They eliminate the wasted labor before it ever hits the income statement. That's how you double your gross margin without selling a single extra lens.
So, what does this all mean? Because if you stop reading at the earnings press release, you think this is just a flawless turnaround story.
Right. But you can't just read the glossy press release.
Exactly. To be fully informed, you have to read the risk factors in the Form 10K, and that's where we get the reality check.
The 10K strips away all that forward-looking optimism. The balance sheet is actually really messy.
The debt drama is wild. So in Q3 2025, Syntec fell out of compliance with the financial covenants on their M&T bank loans.
Which is an existential threat for a microcap company.
Yeah, it means the bank could technically demand immediate repayment. To secure a waiver in November 2025, they had to agree to pay down $1.37 million in debt.
And they didn't really have the free cash flow to just comfortably make that emergency payment.
Which leads to the wildest detail from the 10K. To make that debt payment and keep the company from defaulting, the CEO, Al Kapoor, had to personally step in.
Yeah, out of his own pocket, basically.
He gave the company a $1.26 million subordinated note at a 6.953% interest rate.
A subordinated note means he takes on unsecured risk. If they go bankrupt, he gets paid last.
But the conflict of interest here is crazy. Kapoor doesn't just run the company, he owns a staggering 83% of the shares.
Yeah, and for you listening, that 83% ownership means Syntec is classified as a controlled company.
Which changes the rules, right?
Dramatically. It legally exempts them from NASDAQ rules that require a public company to maintain an independent board majority. They don't even need independent compensation or nominating committees.
So you have one guy who acts as the CEO, the majority shareholder dictating the board, and the emergency lender keeping the company afloat.
It is an extreme concentration of power. And it makes the auditor findings in the 10K deeply concerning. The 10K reveals material weaknesses in their internal controls over financial reporting.
Right. Things like a lack of formal reviews for journal entries and significant issues with IT access controls.
Which means the systemic guardrails inside their accounting are flawed. Without secondary reviews, someone with the right IT access could theoretically alter the books without an automated approval process.
Wow.
Yeah, when you combine material weaknesses with an 83% insider ownership structure that lacks an independent board, minority shareholders are basically just strapped into the passenger seat of Kapoor's vehicle.
Operating purely on trust. And that reality heavily complicates the whole narrative of their margin improvement.
It really does.
And we see that same tension when we look at their tax situation. Now, I want to introduce this strictly impartially, just looking at the factual impacts of the legislation. On July 4th, 2025, the One Big Beautiful Bill Act, or OBBA, was passed.
Right.
Factually, this law restores immediate 100% tax deductibility for domestic R&D, and it allows for 100% bonus depreciation for manufacturing property. For a company like Syntec doing heavy R&D and buying expensive nanomachining equipment, that reads like a targeted financial stimulus.
On paper, it is incredibly advantageous. It should drastically lower their tax burden. But the sober financial context from the 10K is that they can't fully utilize it right now
Wait, really? Why not?
because Syntec currently carries a $3.18 million valuation allowance against its deferred tax assets.
Okay, we should explain what that means.
Basically, a deferred tax asset is like a coupon built up from past losses that you can use to lower future tax bills. But you can only use it if you actually generate taxable profit.
Oh, I see.
A valuation allowance is the accountant stepping in and saying, look, given your long history of cumulative losses, it's more likely than not that you won't generate enough reliable profit in the near term to actually use these tax benefits.
So regardless of this shiny new legislation, the accountants are doubtful they can even use the tax breaks right now.
Exactly. They have to prove they can sustain that Q4 profitability before they get the benefits of their past struggles.
That perfectly synthesizes this whole deep dive. Syntec Optics is just a fascinating paradox. On one hand, it's a vital high-tech cog in the U.S. defense, space, and AI machinery, benefiting from massive legislative and geopolitical tailwinds.
Yep.
On the other hand, it's a microcap company going through these incredibly painful, messy, growing pains, financial controls, near default debt restructuring, and heavy insider control.
It really is two different companies fighting for control of the same warehouse. And I want to leave you with a final thought to ponder here.
Please do.
As artificial intelligence, autonomous vehicles, and automated defense systems get exponentially more advanced, we constantly obsess over the software and the microchips.
Right.
But the ultimate bottleneck might not be the code. It might be the physical eyes of the machines. If reshoring advanced manufacturing really becomes the global standard, you have to wonder how many other hidden, unglamorous microcap manufacturers are sitting quietly on the most mission-critical supply chains of the 21st century.
Just struggling to balance their own books while holding the keys to the future.
Ex-
What a wild thought. Well, thank you for joining us on this deep dive into the hidden hardware of our future. As always, keep questioning the narrative behind the numbers.